Hey everyone, this is Jose Blasco here. We're about to start, like 20 seconds away from the start. Please sound check. Everyone, give me a short message on the comments box so I know you hear my voice. Just a quick message would do. Thank you very much for the sound check. Perfect. So we just reached the top of the hour. It seems that the sound is okay. Therefore, I'm just gonna close the windows and maximize the presentation slide so we can officially welcome the session for today. A pleasure to see you guys. As always, many familiar names in the chat box, which is very, very nice to see. Wonderful. Let's begin. Welcome, everyone. Today is 1st of August, 2019. My name is Jose Blasco. I will be your guide. And today, the idea is to guide you into identifying longer-term opportunities in the market. Okay, so we're getting together for longer-term purposes, being longer-term, anything above and beyond intraday trading. Okay. Normally, we concentrate on what would be known as swing trades. But it could be anything else if we find any valid opportunity, okay? As always, before we start, we have a disclaimer, so we'll do that, and then we'll be ready. The following videos, clips, demonstrations are for educational and instructional purposes only. Traditive provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through a demonstration do not indicate in any way the results you may receive on using our products. And this is the end of the disclaimer, and therefore we are done with the introduction and we are ready to begin. Perfect. So here's our beautiful train station, as I always say, which is really cool. And also our beautiful UFOs, which are even cooler, I would say. And they are our bread and butter when planning trades, isn't it? And so we have all the tools that we need. Today, since it's a longer term day, I have been running the scanners before the session started. And I have been identifying, a collection of symbols that may represent opportunities. So the idea is to go over the process that we follow, normally on the Thursdays, not always Thursday, but almost always Thursdays when we do the longer term, and just look at those directional trades and those non-directional trades and just identify those opportunities. And then depending on what you have running in your accounts at the moment in time, some of those trades may need to be entered by you, so you can benefit from the opportunity. Some of those trades may imply too much exposure and therefore they should be avoided. Okay, so that would be the time where you may want to execute those trades with paper money. That could be a good idea for practice purposes. Remember, we talked about, I think it was 2 weekends ago, we talked about portfolio, building a collection of trades running that we run in parallel. And we talked about having proper delta exposure, having proper gamma exposure, having proper theta exposure, etc. And that's what I meant when I say some of the trades I will present you with may be valid for you to execute in your own account based on the trades that you currently have running. Some of the trades may not be valid and therefore out of practice, because a common saying is that practice makes perfect, isn't it? So out of developing your skill, you may want to practice those trades, and then you would want to use paper money in this case, okay? But putting that on the side, I'm just gonna treat all trades like they are all valid, as long as they meet our rules, okay? So let's begin, and I'm gonna start with non-directional trades, okay? And I'm gonna go from the upper part of the list all the way to the bottom part of the list. Of course, I said that many times that when doing, especially when we do non-directional trades, most of the times we do iron condors. Iron condors are strategies that utilize 4 legs at a time, 4 options together at the same time. And this obviously has a pretty intense, oh, sorry guys, I'm just opening I just want to open briefing.com, and I thought I was doing it on the other computer screen. So bringing briefing.com to the main screen right now. So I was going to say that the iron condors are option strategies that utilize 4 legs at a time, and therefore many times you have seen me be quite picky when it comes to the list of symbols that the scanner has identified for us, because since we're using 4 options at a time, well, if those options were not to be liquid enough, next thing you know, you would get 4 times slippage, and that could really hurt the trade. So normally when looking at non-directional trades, I'm going through this list having 2 things in mind. Number one, is it a liquid option or not? I mean, if it's there, it's not going to be terrible because the scanner is filtering for liquidity. But at the same time, and this comes from pure experience, okay, and many of you know that, there are certain stocks that for whatever reason you get filled more easily than others, okay? Like you may build an iron condor, instead of going for the bid or the ask price, you may want to go in the middle of the spread. And with certain stocks, you get filled very easily in the middle, where other stocks, you need to be way closer to the bid price if you want to sell, way closer to the ask price if you want to buy, for you to get filled. This is coming from experience, and this has to do with you have taken some trades with that stock already in the past, and therefore you know that stock. Okay, so it's nothing magic. Okay, so you will see me be a little picky with the list, going for the stocks I know have better liquidity at the beginning, and also taking those particular symbols and inputting them in briefing.com, because we always have this thought in the back of our mind as well, which is, okay, why is it that the scanner identified those options as very, very overpriced? So why are those options overpriced? And the classical reason is because earnings is too close, right? And we don't want to trade non-directional trades into earning, because earnings normally generate very strong moves in the market. And you don't want this to kind of explode on our face in the middle of a trade, isn't it? So non-directional means you want the market not to move much. Therefore, we always need to stay away from earnings. Okay. So nothing that you don't know, but I just thought it would be a good idea to have a little bit of a summary of key thoughts, because of course some of you are new to the group and so on, and I want to make sure everybody is safe. Okay. So Biogen, okay, Biogen, that's a nice stock, to be honest. It's a nice stock when it comes to volatility, and it's also a $200+ stock. So normally you find okay opportunities, okay, but you have to be a little careful here, because in this case, notice how far those UFOs above are. Okay, so I'm not sure this is gonna work unless we have pre and post market data close by. No, with pre and post market data, we only get 42%. So we're gonna totally ignore Biogen. Okay, so we're gonna go for CNC. CNC is providing us with 43% with pre-post market with regular session. That's 47.85. I'm not super happy about that. So if I find nothing at all, I'll come back to CNC. You've seen me before do non-directional trades with 48%, something like that. I could take it, 47.85. I could take that. But since we got many other stocks in the list, okay, there is no need to rush. Okay, CVNA. This is a stock that I have not traded before, and therefore I'm not sure what the liquidity of options will be. Okay, so we'll give it an opportunity. So 52%. That's what we get with a regular session. Pre and post market, we got 39. Okay, so certainly not pre and post market for that stock. Okay. So let's go ahead and take a look at when the earnings are going to be for CVNA, because we need those earnings to be at least, either before tomorrow, either tomorrow. Okay, if we do a very short trade, which I doubt we can do that with a $60 stock. Okay, because tomorrow is very little time, and therefore the premiums are going to be very low. Okay. And if that one doesn't work, then we need to go for the next expiration date, which instead of August 2nd would be August 9. So a problem with CVNA is that the earnings, as you can see here, are on August 7. August 7 being before August 9, that means that we're gonna pass. Okay, so CVS will be the next one in the list. Okay, CVS we got 48.99 with regular sessions. If we add pre-post market, we got 55. That sounds good to me. I'm okay with 55. So now the question is, when are the earnings for CVS? Okay, oh, sorry, I just got the wrong symbol here. CVS. So with CVS, we got August 2nd. Okay, so we have a little bit of the same situation. And again, I will not waste the time, because $55 stock, if I sell 58 options, I'm gonna get nothing, okay, using tomorrow expiration. HYG, it's another symbol I will skip, because that's an ETF, okay, just like LQD is also an ETF, so I will skip those two. ETF almost always, like 99% of the times, carry much less premium compared to individual stocks. And because we are doing non-directional trading, we want to capture a greater amount of premium. We are selling options. The most you will make is what you get paid, and therefore you want to get paid the most as possible. So what do we have with LNG? With LNG, we got 50.86% with pre-post market. With regular session, we got 54. That sounds good to me. Nicely located in the middle between those UFOs. So that looks like a good setup. Let's see if earnings-wise, we are well located as well. I don't know why this website does this many times, where it kinds of invert the typing. So August 8th, okay, so the only way to do this trade would be using tomorrow expiration, and unfortunately a $65 stock will probably not provide that. Okay, so let's go for OXY. And again, this is a process that when you do this by yourself, and I can see Bojan is doing trades with the crude oil while watching the lesson. Love it, my friend. Multitasking, always trading. Okay, way to go. Love it, love it. So we got 46% and we got 44%. So I'm not inclined to execute a trade with that one. PXD. Happy dance, Jose. Happy dance. Love it. So 51, and then we go for pre-post market. So 51 becomes 42. So yeah, so in the case of PXD, Pioneer Natural Resources, we will need to stick to the regular session hours. And again, very well located with multiple UFOs above and below price. $138 stock. This is getting exciting. Let's see if earnings-wise we are okay with the dates. August 6th. Okay, so August 6th means that the only thing we can do is to use tomorrow. Okay, and you know what? Because it's not too likely to work, because $138 stock is not like it's so expensive, but at the same time, it's always worth it to check. So what I'm going to do in this case, we still have 20 minutes before the market opens, so I can still check the option chain. So very quickly, I'm going to look at those options around 140, 142, something like that, to see what is the premium available for those options. Okay, and we have a rule where we are always shooting for a minimum of 35 cents when we sell options. That's the minimum. So I am curious to see if we will get that. If we don't, we'll go for the next stock. But if we do, then we'll plan a trade, which is going to be a 2-day duration trade. Okay, so August 2nd, here we go. That's PXD, Pioneer Natural Resources. And when we do the 142, 143, so the midpoint is like 32. Okay, so I'm not sure what we'll find when the market opens, because of course this was the data out of yesterday close. Okay, that was the data out of yesterday close. So I'm not sure what we will find when the market opens, but it is, I would say, possible. It is a possibility that we will have the minimum premium that we require for those trades. Okay, so just to kind of remind it to the whole group, in case you have forgotten, let me open our sharpening notes. Okay, let me open our sharpening notes here, and I'm just gonna scroll down until we have the rules I was just referring to, which are no, I just went too fast, I believe. Here we go. They're here. Okay, so we are always shooting for 35 cents. That's the minimum that we really like. In certain cases, we open the door to 25 as a minimum. Okay, when is that? Well, let's say, for example, in this case, you get 32, which is less than 35. But let's say on the other side, you're getting 50. Okay, so even though 32 is less than 35, it's okay, right? Or if you get 50 here and here you get 25, it's not ideal, but it's still okay, because the other side, the put side, is providing, let's call it additional premium, and therefore, it could make sense. Okay, it could be okay to think of taking this trade. Okay, so we'll come back to PXD right as the market open, because again, this is market data updated out of yesterday close. And because today is Thursday and tomorrow Friday, and therefore we got 2 days to expiration, and time decay moves quite quickly as expiration approaches, which is on Friday. So we may or we may not see those values when the market opens. Okay, so instead of spending time to do the trade, which I don't know if it will work or not, I will just leave it there. I just made a note for myself, and the first thing I'll do when the market opens is to go back to PXD. Okay, what about Qualcomm? Okay, so Qualcomm, we have Qualcomm earnings date would be, let me see, 31st of July. Okay, so here I have a doubt. Okay, I have a doubt, which is, let me go back to the daily time frame here, and let me activate implied volatility. So you know, with TradeStation, implied volatility is a value that updates only at the end of the day. So the updated value is 95. Okay, but if we look at the real-time value for implied volatility, given the fact that Qualcomm got earnings July 31st, which was yesterday, I am concerned that the value may be much less. Okay, and as you can see, yeah, unfortunately, I am correct. Instead of 90%, we got 50, 40, 39. So the volatility has dropped massively. The overpriced options that the scanner has identified are not overpriced. They are overpriced in the scanner because the scanner is using 95 as a value, which is the one that TradeStation updates end of the day. But that one is not valid, because again, it has not been updated yet, given the fact that earnings took place after the market closed yesterday. Okay, so we're gonna have to skip on Qualcomm, and therefore we go for Rio. Bojan, Jose, any chance we could review the STZ trade from 3 weeks ago if we have time towards the end of the session? I believe I was supposed to close it if it fell below 200, but I'm new to options. Yes, we can certainly do that, Bojan. And if you kind of feel that I have forgotten, please make sure you remind me, okay? And that way, for sure we'll do it before the end, okay? So we got 35%. Okay, we got 35% and 34% with Rio. So we're not gonna touch Rio. The way the large market players trade Rio, they do it in ways where they cancel their orders. Valero Energy, that may be a good one. VLO, again, the website got it backwards. VLO, that would be October, and yeah, so that's October. Yeah, and it's interesting because we got, I'm just looking here, we got January plus 3, that's April, which is 4. Okay, so January is 1, April is 4. Then if you have 3, 4 and 3 is 7. So I believe 25 of July, this corresponds with the earnings report that just happened a few days ago. But it's interesting that they didn't report the EPS value, the earnings per share value, like they always do. In that last quarter, they haven't, okay? But in any case, it seems that the next one is gonna be October 24, which is again 3 months after July. So July is 7 plus 3 is 10, which is October. So I'm gonna be okay. And therefore with Valero, we do have an opportunity to plan on a trade here. It's an $85 stock. That's a valid price point for non-directional trades. So the only thing I need to check here is pre and post market versus regular. So pre and post market is 47, where regular is 54. So we're gonna use 54. Okay, so let's begin planning this trade with Valero Energy, because this one is looking quite solid for us to have a valid trade. So I'll begin with VLO, and as the market opens, as I said, I'll go back to PXD as well, and we'll take a look at that. Okay, so again, so Valero Energy has earnings that will be reported in October. Okay, so you can use anything before October, of course. The shorter the expiration date, the better. So we're gonna use August 9. We'll skip August 2nd because again, it's $85 stock. It's gonna be very difficult to find those 35 cents that we need, correct? So analyze and sell. I'm just gonna mechanically, without even thinking, add an iron condor. So this gives me the opportunity to change -5 and +5 to be +1 standard deviation and -1 standard deviation, okay? And because I got the date of August 9, so this is telling me 82.28, that's how low the market should go, and 88.33, that's how high where the market should go. So my goal now is to find UFOs around those price levels. So we got 82.9. Okay, so 82.9 is above 82.2, so that's not good. So therefore, I'm gonna have to use 80.88. Okay, this is where this is the UFO I would utilize to defend myself in case the non-directional trades becomes directional. And oh, got it. Thanks for that, Mark. Good that you got the EPS value. And then 88.33 would be somewhere in the middle here. Okay, so we could certainly go for that one. Okay, that would be 89 something, which is certainly above. Okay, now at the same time, while this is valid, I would also like very quickly to do a little bit of a vertical measurement. So from here to here. Okay, and I will want to extend this to the upside. And if I do, I am slightly, very slightly surpassing the upper line. So, you know, I would prefer to plan the trade using the next UFO. Okay, I would prefer to do that. I'm not sure if I will have premium enough. So if I don't, I'll still be happy using 89.23, but it would be a little bit better balanced, if you wish, to use 90.73, because apart from the vertical distance that you have to the purple lines, that way you would have 2 red UFOs to defend yourself and 2 emerald UFOs to defend yourself as well. Okay, so you have the emerald below and the ruby above. Okay, the green and the red, however you want to call it. So let's go for it. Okay, so let's be a little more specific now when looking at the option chain. And the first thing is, if I sell the 91, how much I get paid? Well, with that expiration date, as you can see, nothing. Okay, so what if I sell the 89? So with the 89, I will get paid 14, which is not enough. So because it's not enough, that means that August 9 is too short as an expiration date, and I would now then I would need to use August 16. Okay, August 16 would pay me 34 for the 89. Therefore, it's looking good for August 16. Now the question is, if I change this particular expiration date to August 16, the question is, my current 88 and 82 are gonna change. Okay, so what will be the new value? So let's do it. Change to August 16, 1, 2, 3, and now it becomes 89.55 and 81.16. So this, I said 89.55, therefore this one is not valid anymore, and therefore I will need to be using 90.76. Okay, so that would be the one I need to be using, and 80.86 is valid because 80.86 is still beyond 81.16. Okay, so this is the trade that we would want to build. So if I do 90.76, I'm having a problem here because I am getting 22. I'm not getting the 35 I need. If I do 90, actually I should do more than that because it's 90.70 something. So that will probably force me to go to the next one, okay, where now I get my 34 with August 23. Okay, so again, just like PXD, this is market data that has been updated as the market was closing. So I know I do have an opportunity here. It's looking like we may find a way to set up an iron condor that will be valid. And therefore, what I'm going to do is just wait 8 minutes for market to open. So before, instead of, driving too many conclusions out of these values, since those values are about to be updated in 8 minutes, I'm just going to leave it there. And I know that for non-directional purposes, I got PXD and VLO. With PXD, remember, it's going to be a 2-day. And with VLO, probably we'll have to use August 16 or beyond as an expiration date. So it's going to be one iron condor would be very short duration, only 2 days. The other iron condor will be a little bit longer, like 15 days or so. Okay, that's the plan, and we'll come back to this as the market opens. This type of analysis, okay, which I am performing in front of you and kind of sharing my thoughts as I go through the process and change symbols and look at the option chain and load the UFOs and all of these things. This is the process that I'm basically sharing with you in a way where what I'm trying to help you do is that any day you could be replicating that yourself. And the idea is that you would be replicating that yourself before the market opens or after the market closes in the evening hours, if you're in the States, for example. So you are ready for execution the next day. Okay, and so basically the next day you would still need to review the plan you did the prior day as the values in the option chain begin updating with the new day, because options have time decay and all those different things that affect them, and therefore you will want to reconfirm that the trade you plan the day before is still valid the day after. For us, the day before is just 8 minutes before the market opens, but still, it's like you have done it yesterday in the evening if you were in the States, or early morning in Asia, or very late at night in Europe. Okay. Cool. So while we're waiting for the market to open, I'll move now into directional opportunities. Okay. So I just clicked on a directional long. Okay, and we end up with a collection of symbols here, and I would like to begin. I'm going to start from bottom to top. Okay, so here is Snapchat. So let's take a look at what we have with Snapchat. So we got 56%. The price we're looking for, again, first of all, Snapchat is a $16 stock, so it's not ideal, but also the average is 16 point something, and 16 point something, we have no green UFO. It's a shame because those UFOs are working 56% of the times, which is quite high for stocks, because remember, stocks are fragile. They depend on other forces. So I'm going to check on the pre-post market to see if we have something. And you know what? We kind of have something here. Yeah, we kind of have something. Remember, we don't need to be super precise with the UFOs. Wait a minute, I got 53%. With the regular session, I got 56. Okay, so yeah, we have no trade, guys. Even though with the pre-post market, we got 53, and it would not be a crazy thing for you to do it. We said the right rules to follow is use the settings that give you the highest UFO performance value, okay? And therefore, that would be for Snapchat regular session, so we're not gonna change that. So let's take a look at Schwab. Okay, let's take a look at Schwab and see what do we have with Schwab. So very similar setup. 43 is the average. We got 49.59. If I change it to pre-post market, we got 42. So that is not good enough for a directional trade. Okay, so IEF is an ETF. So I'm gonna move into Google. Okay, Alphabet, and see what is possible. So Google shows 52% with regular session. With pre-post market, it's showing, okay, so it's downloading, I guess, so we'll wait a second. The average is around 1,187, so 1,200 more or less. We got 52% with pre-post market, and we have 52 point something, so the 52 point something is better. But unfortunately, we don't have anything around 1,200. Okay, the next UFO is found down at 1138. Okay, so price is further away. So no directional trade on Google. What about DHI? Okay, so it's pending data, so I'll wait. And what about APC? So APC is also pending data. Okay, so I will come back to this talk in a minute. So back to DHI. So again, DHI, $45, 45 point something is the average. So we would like to find green UFOs around this price. This is where we want to buy. And again, we could certainly look at all the details in the methodology. So the close is above the average, the DMI is blue, all those things. But the fact is that the scanner already did that for us. Okay, so we can certainly save steps. Okay, and what do we have? 54% is what DHI is providing for us. With pre and post market, 54 becomes 44. So no pre-post. We're going to use regular session. And the next UFO here is around 44. Okay, so we have a little problem. We are looking for UFOs around 45, and we got no UFO around 45. Okay, so 44 is too far down for us to take this one. Okay, and by the way, 3-4 hours from now, you may have a UFO at 45. Okay, it takes a few candles to form a new UFO. And every candle, as you can see, I'm using the 55-minute time frame, isn't it? So every candle, 3, 4, 5 candles, that's 2 hours from now, 3 hours from now, you may have a UFO. So those are trades that you may want to recheck a little later in the day. Okay, the market is about to open, but let's see if we can still have time to check out APC. So APC with an average around 73.51. We have 53%. With regular session, pre-post market will bring that value to 50. Therefore, regular session is the way to go. okay, and the next UFO we have is located at 72 point something. That was very interesting. It's almost copy paste. Most of the stocks that we found are almost copy paste. We are looking for 53.71 and sorry, 73.51, and that falls above the green UFO, which there is no UFO there. Okay, so all the longs will not qualify as valid as of now. Okay. So we're gonna start with our non-directional plans. Then we will look at the shorts afterwards. So I'm coming back to Valero Energy, which is well, actually I'm gonna start with PXD because this one only have 2 days to expiration. The market just opened, okay? The market just opened. PXD opened moving down by 2%. Well, this is likely going to kill the premium that was available at 142. Let's take a look because of course when the price goes down, the value of the calls go down, and we may not find the premium we need anymore. Okay, so we are looking at 142 or something. Well, actually we still have premium. That's very nice. Is it 142? Yeah, well, more like 143. Okay, so yeah, let's do it. So I'm gonna analyze and sell an iron condor for PXD. I'm gonna change this to +1 standard deviation, -1 standard deviation. Okay, that would be 137. So 137 means that we're gonna be good enough using that particular UFO. That's 141. And on the bottom part, okay, let's see where is the bottom part is 130.5. So 130.5, okay, that's good. We got the 129 here, so that's going to be good. Okay. Yeah, certainly I'm not too comfortable. I would love to see the price of that stock to be somewhere in the middle. Okay, where right now we are much closer to the bottom part, as you can see, than the distance to the upper part. Okay, there is much more distance, so we are not in the midpoint of the range, which is not ideal. Okay, so I just clicked somewhere. Oh, I just clicked here by mistake. So let me go back to VLO. So I want to, sorry, PXD. Here we go. So I want to take a look again at pre-post market and regular session. So 51.58, and this becomes 41. Okay, so yeah, so we need to be using a regular session for PXD, and that's the setup. Okay, the other possibility would be to sell the 120, but I don't think, or the 119, but I don't think that we will have premium if we sell anywhere. 120 is no way we're gonna have premium. Okay, so let's go for it. Okay, let's go for it. We have 52. Okay, we have 52. Yep. So 129.35. That's quite interesting. This is quite interesting. So the 141, which is very far away, has more premium than the 129, which is closer. This is actually not making sense. So let me close. Okay, now we just updated now. Okay, yeah, it just updated now, yeah, we need to revisit this trade in a little bit later because for whatever reason I got all of these zeroed out. Yeah, so I'm not understanding these values. Okay, so probably it'll take a little bit of longer time for the market makers to make up their mind when it comes to which values they want to assign to the options on that stock, given the fact that that stock is being killed with 5% drop right at the open, and that may be the reason. Okay, so therefore we're just gonna do nothing for now. And we'll come back later to see what's possible here, and therefore I'm gonna go back to VLO, which is gonna be an easier trade to plan. At least I believe that's gonna be the case. Okay, so Valero VLO. So let me add it again. VLO. Okay. So very good. It's here. So we said that with Valero we were going to use August 16. And we said that 89.36 89.36, yeah, so we're using 90.76, and we also said 81 something, so that's 82. Yeah, so we're good. Okay, so the values that we got are valid. So now the question is, if I sell the 90.5 or 91, how much do I get paid? Okay, and we can see here the 90 pays me 22, so unfortunately August 16 is not valid, and I will need to be using the next expiration date, which is August 23. Okay, so I can do it because earnings is in October, but the question is, if I change it to August 23, am I still gonna be okay with those UFOs? So we're talking about 1994, okay, which 1994 surpasses that value, okay, surpasses that value, and 8086, that one is okay, okay, 8086, that one is okay, 80.60. okay, so now dealing with options, okay, it's when we do sessions together to deal with options, I try to make it as straightforward as possible, but the reality is that options give you options. There are many moving parts, and there are certain times where it may make sense to look into it just a little extra, okay, because the liquidity, like for example the 90.5, from 46 to 20, you got like 25 cents difference, which is even more than what you get for the bid. Where if I use August 16, liquidity is still not the best, okay, but it's much better. You would be well, in this case it's really not good either. Okay, so yeah, I'm just looking at those values to see if we can just make it work, because it's really close to work. But of course, if I don't see a reasonable way to justify the decision I'm going to make, meaning that I'm going to have to bend the rules, then I'm not going to do it, because we don't want to do that. We never want to break the rules, isn't it? So yeah, I just had the visual impression earlier that the 16 had much better liquidity for the 90 strike, much better, but it's not the case. Okay, so hey, we're gonna have to leave it alone and not to do this trade with Valero. Okay, so we are left with looking for opportunities for shorts. And then once I'm done with the shorts, the opportunities for us to short the markets, then what I will do is look into the neutral. So if we cannot do pure non-directional trades, which are iron condors, we can always look into doing credit spreads, either neutral long credit spreads or neutral short credit spreads. I personally always prefer to do the non-directional because you get paid double the premium, I am normally more satisfied to do that, because when I do a non-directional trade, what I really want to acquire is theta, and you get double the theta with an iron condor than what you get with a credit spread. But if the market is not giving me the opportunity to do it, like it's the case today, then I'm gonna have to respect that. Okay, we cannot move the market ourselves. We cannot create the opportunities. The most we can do is to adapt to what the market gives us. Okay, good. So let's go for ABBV. So we have 48% with regular session, 46 with pre-post market. So we're gonna skip it for directional purposes. CSX it needs to load. What about Netflix? Okay, so Netflix, we got 49.46. If I activate pre and post market, we get 50. So that would be the way to do it. So Netflix, it's a down market, isn't it? It's a confirmed down market. It's a rainy climate, right? And the average price is around 328. So 328, we do have a red UFO right here, which qualifies for a trade. Okay, so we just found trade number one for today. And because the climate is confirmed, as I begin looking for the target, I'm gonna have to do that in a weekly time frame, not the daily, right? So switching to the weekly, activating AutoUFOs, okay? And the moment I do that, I'm gonna now find out that my target with Netflix, okay, should be 281.77. Okay, so that would be the target for Netflix, which we just identified in the weekly time frame. So turning on the UFOs back to the daily, so we don't get confused. Okay, and now that we know that the target will be 281, we know we have an opportunity to enter a bearish trade on Netflix. Entry would be 328 with a target below 281.77. Okay, and this can certainly be done. So I need to check two more things to have a final yes, which is first, what is the earning report for Netflix? Okay, which is October 15. Okay, and number two, what is my TTT, which is time to target? So let's bring a calculator. We have an entry at 328.67 with a target of 281.77. So we are talking about a $46 move to the downside. If I was to enable the daily average true range, this tells me that per day as an average, that stock moves $11.44. So if I take my $46 and I divide it by 11.44, this tells me that we're expecting this trade to last 4 weeks. Okay, and because every week is made of 7 days, if I multiply this times 7, that is giving me 28 days. So in other words, we want the selection of the expiration date to be of at least 28 days when looking at the Netflix option chain, which I'm loading right now. But apart from being at least 28 days, which that would be August 30, we also want it to coincide with the earnings report, which is going to be October 15. Therefore, we're going to be using October 18 expiration, which is 78 days from now. Okay, so that's the trade that we're going to plan, and the trade is going to be made of puts because it's going to be a bearish trade. So what I'm going to do without further thinking is to analyze and buy a vertical, because that's the type of trade we're going to build. Okay, and now I'm going to go back to the chart and plan on that particular vertical spread. It's called a bear put spread that we're going to plan on Netflix using puts and using October 18 as the expiration. Okay, so back to the chart so I can explain this better. So first of all, we said that we will have the entry located right here. Okay, so this is gonna be our entry, which is 328. The target is gonna be all the way around 281. Okay, so we are basically trying to capture the range between here to here. This is the path where we expect Netflix to travel through. Okay, to do that, we're gonna have to use our options to build. As I said a minute ago, we're gonna be building a bear put spread. Okay, it's gonna be a bear put spread, and the bear put spread is gonna be made of using October 18, 2019 expiration, as I said before. Out of curiosity, earnings are gonna be on October 15, 2019. Okay, and this could change. Okay, so this is something to be reviewed. Okay, and to build a bear put spread, so basically what you need to do is closer to price, you would buy a put. Okay, and more or less around where the target is, beyond the target, okay, you need to sell a put. Okay, that would be the plan. So since the target is 281, seems reasonable to think of selling the 280. Okay, so let me take a look at the option chain to see if the 280 is available, which I'm sure it is. Here we go, we got the 280. Okay, so we're gonna be selling the 280, and therefore what I'm gonna do here is -1 red color sell. So I'm gonna change 315 to be 280, right? Also, I'm going to remove those price slices, and the one price I'm gonna use instead of 273 is gonna be the entry price, which is gonna be 328.67. So 328.67 will make this options analytical tool to give me the delta value at that price. okay, which is the moment of the entry. Okay, so notice how I got 23 delta. Remember, we want delta to be around 30. Okay, so if I was to use 325, I still got 27. Okay, it's better than before, but it's still not what we want. So this is forcing me to push the 280 down to 275, and this now is making it 29, almost there. So if I make it 270, it should be good. That's it. Now I got the 31 delta I want. Okay, so my trade has been adjusted, and based on the chart, I know more or less the strikes I need to use, and thanks to the analytics built-in TradeStation, I have adjusted my strikes to provide the delta exposure that we have defined in our sharpening sessions. Maka, we want to avoid earnings, okay? Certainly in this trade, like all trades, you will want to be out before earnings, okay? But because we are buying options in this case, so this is a bear put spread, which is a debit strategy. So you are a buyer of options. So what happens is that you're gonna have to suffer time decay. You can see the theta value is negative. So because you're gonna suffer time decay, we're gonna do multiple things to fight it, as explained in the sharpening sessions. And one of the things that we do is to utilize the expiration date, which is the nearest to earnings, because that expiration date is likely going to experience a rise in value as the earning dates approaches, because many people are buying options because they expect something crazy to happen over earnings, and they are gambling about it by buying options. So what we're gonna do is we are buying the options now when the options are underpriced because earnings is far away. Let the trade happen. Hopefully we're right, but no matter if we're right or wrong on the trade, as the earning dates approaches, which is October 15, that expiration date will gain value at an accelerated rate because of the earnings date is approaching. Okay, so what we'll do is that we'll still exit before October 15, but the day when you exit, you would have suffered very little time decay, because again, those options that belong to this particular expiration would have grown in value thanks to that earnings phenomenon. Okay, so good question there, Maka, and it allows me the opportunity to rephrase and make it very clear that you will get out of this trade the moment you reach the target, which is 281.77. But if you didn't get to this target, and now is the day before October 15, you would still need to get out for whatever outcome it is. Is that making sense? Because then you may have this crazy move against you on earnings, and that would be very problematic. Okay? Cool. Very important question. Thanks for that. So 325, 270. This is what we're gonna do. Okay, so we are buying the 325 and we are selling the 270. This is the trade that we're gonna do. Okay, now we are not doing it now because the current value of Netflix it's 323. We need Netflix to react ideally to this green UFO and go back up and go back up and go back up. And the moment Netflix reaches 328.67, this will be the time to enter the trade, expecting Netflix to begin its trip towards the 281 mark, which is the target. Okay, and we will profit from that. Okay, we will profit from that. And if it goes against us, okay, if Netflix comes here and instead of bouncing down, keeps going higher and higher and higher and higher, well, obviously it's a problem. But remember, you are doing this in the context of a portfolio where some of your trades are long, some of your trades are short, you are positive gamma the portfolio, right? So this is not gonna be an endless pain. This is just gonna be a tiny problem while other trades are making money for you. Okay, you are hedging your portfolio, isn't it? And in the meantime, it's not like you are gambling or hoping, please come back, and it's unreasonable hope. Okay, you know ahead of time that the day you buy the bear put spread, this bear put spread will cost you $1,588. So what's the most you can lose? $1,588. So if your account is, I don't know, whatever, 100K, okay, this is like 1.5%. Okay, and if you're happy with it, you take it. And if it's too big, then don't take it with Netflix. Obviously, Netflix, it's a highly priced stock. It's $300+ per share. Therefore, the options are priced accordingly. And this trade is a little bit in the expensive side. for traders with small accounts. So probably if your account is limited, you will probably not execute this trade. If your account is of the right size, you will execute this trade, and you should have a nice peace of mind knowing that the most you can lose is 1,588, because there is no way you can lose more than that if that's what you pay for the options. Is that making sense? So let's say you're happy with all of this. So it's time to place the trade. So to place the trade, you just click trade. And now what we'll have to do is to activate this trade based on a price condition of Netflix. Okay, and the price condition would be to reach 328.67. Okay, so in other words, if Netflix reaches 328.67, okay, then do the bear put spread. So I'm just gonna place order. The order is to buy a vertical spread if Netflix as a stock is above or equal to 328.67, and that would give you permission to do the trade. So you click yes, and now we have not been filled, okay, but the order is in the system as a receive order. Okay, we have a Netflix spread waiting to get filled with a condition based on the price of the stock. Okay, and now you can leave this trade alone and be okay with it. Okay, so we got trade number one of the day, and that is Netflix. Okay, we're gonna continue our process of identifying more trades, hopefully all clear with Netflix. Okay, so CSX, I believe I didn't look at this one because it was loading the market data. Yeah, so 44%. If I look at regular session, it would be 50, so that's fine. But yeah, so we got moving average at 70, no UFO at 70. So we're gonna move to TAL. Okay, TAL, and then we will also look at Under Armour. Jose, any particular reason why my numbers in Options Station Pro are always different than yours? Yes, I believe that the reason is probably because when you look at the settings, you may not have checked use midpoint as price. That may be the reason under common when you get into settings. Okay, let me know if that's the case. Okay, when you do it. Okay, because if you do that, then we should be absolutely equal. Okay, so what do we have? Under Armour 54. If we look at pre and post market, it's 55, which is better. Unfortunately, 25 is the mark, and we got no UFO at 25, so we cannot do anything with Under Armour and TAL that was loading. So what do we have? We got 37%. If we look at regular session, it's 47. That's not good for directional. So that's it. Okay, so from a directional point of view, we got the trade with Netflix. That's what the market is giving us today. And therefore, the remaining 8 minutes in the session, you have midpoint as the price checked. Do you have the same value as me here, 328.67? Okay, Bojan, this could be another reason. Okay, because if not, then it's difficult for me to understand why. So yeah, so the remaining 8 minutes of the session, we're gonna spend them looking at neutral trades. Okay, so neutral trades are trades that meet a similar condition compared to directional. Okay, so there is some directionality in those neutral trades, but the options are too pricey, the options are overpriced, and therefore buying options will make no sense in this case. They are overpriced, and therefore what we're gonna do is that we're gonna do credits, as you can see written. This means that we're gonna be selling options, okay? You have the same issue as Bojan, okay? So then maybe you guys don't have an issue, and maybe I have an issue. So let me close Options Station Pro, and I will reopen it just in case something got stuck. Okay. So yeah, so basically what I was saying is that the neutral trades are kind of like the directional ones, but because the options are very pricey, we're gonna focus on selling them and create credits. Therefore, we don't necessarily have a target. okay? So we are not directional. Directional means you have a target. So we are not necessarily directional, and therefore we're gonna be, just collecting time decay, okay? That's very similar to purely non-directional. The only difference is that there is a little bit of a bias, okay? For example, if you look at ADM, okay, you will see based on, on the chart on the bottom left, you can see that this market is clearly moving up. So we have a defined climate where that market is moving up, and therefore, we are in a different situation, okay? Okay, let me open the option chain as well, so that way we can check if the issue has been fixed. And also I want to go back to briefing.com to double check the earning dates on ADM, which is August 1st. Actually, it's today. So we're gonna have to use ATVI. Okay. Yeah, so here's the value for Netflix now, 1582. You guys have the same, or do you still have something different? Okay, 1583 now. It's fluctuating around that value. So anyway, so ATVI, August 8, okay, so August 8, it's before August 9, so it doesn't work. What about CAR? 1595. Dirk, are you using midpoint? So if your value is higher than me, maybe you're not using midpoint. Okay, so we still need to download the data. So I click Devon Energy. Let me check some of those earnings dates as well, because this could be a way to discard some stocks. So CAR, August 5, we're not gonna do it. DVN, that would be August 6, we cannot do it. What about GWN, August 21st. Okay, so that one works. So we look at GWN. Interesting, guys. Interesting. Okay, so pending data for Nordstrom. Again, we saw earnings on the 21st. So when looking at the option chain, we can look at anything prior to that. Okay, ideally, we could use August 9. Okay, now that stock is not too pricey, $32. Okay, so we better have UFOs not too far away, because if that's not the case, then it will not work. Okay, so 51%, with regular session. Pre-post market will provide 50, so 51 is better. So what if we do August 9 and we do a bull put spread? So I'm just gonna analyze and sell a vertical, and I'm just gonna be looking at the bottom part, minus 1 standard deviation. That is 30.5. Okay, 30.5 happens to be right here. Okay, so actually, based on UFO and probabilities, it seems to make sense to do a put spread right below 30.5. So the question is, if I sell the 30.5, how much I get paid? And I get paid 18, which is less than the 35 I want to get paid. So it will not work. Okay, so that one is not providing premium enough. So we're gonna have to look at the next one. So MOS, Mosaic, August 6, no, it's not gonna work. So then I could go back to Valero. Valero, notice, remember, we had Valero in the non-directional place, isn't it? And I was a little, well, I need to go back to PXD as well to recheck those values. But the Valero trade, I was not too happy with the values I've seen in the option chain. Having said that, that was when I was looking at it from the point of view of purely non-directional. But since this trade is also showing up in my neutral scan, maybe if I was to only focus on the put side and forget about the call side, maybe I can make it work. So VLO doesn't have earnings until the 24th. Okay, which means that I have premium available now, and I can use virtually any expiration date I want. Just like the same case that we saw earlier with the Iron Condor. The only difference is that I'm just gonna focus on one side of this equation instead of both. Okay, so let's say that we're gonna do August 9. So if I pick any put and I analyze sell a vertical, and I remove the Iron Condor I had before, this is telling me 82.71. This is how low the price should go from the current price. So 82.71, it is below 82.9. So I cannot use this UFO, but I could certainly use the next one, which is 80.86. So 80.86 would pay me, may work. So let me add a few more strikes only. So if I do 80.88 is the bottom, so I can do 81. If I do 81, 81 pays me 32. Okay, it pays me 32. So I can do that. Okay, I could do that. Okay, the problem I can see is that if I do 81.80, for example, okay, if I do 81 and then I buy the 80, so buy 80 and sell 81. Okay, the problem is that I only get 6 cents of net credit, and as you will probably remember, okay, we need at least 15% of the difference between strikes. So if the difference between strikes, which is 80 and 81, is 1, 15% of 1 is 15, and this combination only pays us 7. So what's the problem? Well, the problem is that the expiration date is too close. So what if we use August 16? Well, if I use August 16, okay, I am looking at 81.23. So 81.23 on the chart is above 80.86. Okay, so I could use my 81, same as before. So if I do 81.80, okay, now I have $1 risk, but notice how nice is this. Now we got our rule being met. I do get the 15% of $1 as a credit. Okay, so it's not like this is the most juicy and most profitable trade in the world, but it does meet the rules, and therefore it's a trade that you could execute. Now, before I do it, I want to look at another possible combination with 81 and 80.5, or also 80.5 and 80. So I actually want to look at 3 combinations. Okay, I want to look at 3 combinations, and I'm going to write it down so that way it's clear for you guys. Okay, so I would like to do 81, so sell the 81 put and buy the 80 put below. Okay, and this we saw gives you 15 cents. Okay, we saw that. But also I want to look at 2 more combinations to see which one is the most efficient one. I want to look at 81 and 80.5 and see how much this provides. And I want to look at 80.5 and 80 and see how much this provides. And then I will want to calculate this as a percentage. So this is 15%, right? 15% of $1 is 15%. So I would like to know what's that percent, and I would want to see as well which one is that percent to know which is the most efficient combination, and I would then plan on executing that one. Okay, so let's go for it. I'm going to analyze duplicate trade and analyze duplicate trade. So I got 3 times the same trade. On the top I got 81.80. In the middle I would do 81 and 80.5. Okay, this produces 8 cents. Okay, so what is my risk? Okay, this produces 8 cents. So what is my risk? Well, my risk is 0.5. Okay, 0.5. And how much I got? I got 8 cents out of 0.5. So percentage-wise, that's 16%. So this trade seems to be a little more efficient percentage-wise. Okay? And what about if I do 80.580? So that's going to be case number 3. Okay, and it's funny how TradeStation doesn't update it unless you click. So, and then you have the 80.580. 80.580. So if you do that, this is providing 7. Okay, 7, well, everything is 7 now and 14, so everything has changed, but it's kind of the same. Okay, it's kind of the same. So this is providing the same. I'll use 8 just to compare with what we had before, right? Because it's the same thing, which is the same 16%. So now, which one has the greater risk? Well, the one with the greatest risk is this one, because 81 is the nearest to current price, and you get the smaller value. This one is the second one with the greater risk, because 81 is just as close as before. Okay, even though this one gives you just a little extra premium, the risk is the same. So if I was to pick between the two, this one is better, okay? But this one has less risk than the two above, because in this one, you get in trouble below 80.5, which is lower than 81, and you get the same. Therefore, the recommended or the most efficient trade, and this is common sense, isn't it, would be the one below with 80.5 and 80. Okay, so this would be the trade that we would be executing using August 16, 2019 expiration date. We would be selling the 80.5, 80 bear put spread. Okay, so I'm gonna get rid of this one and this one. Okay, I am left with 80.5 and 80. Notice how the prices are fluctuating. Okay, so sometimes presenting the trade and spending too much time talking about it is not ideal, because now I just lost 2 cents. But in any case, notice how 3 cents now. So it seems that this stock is moving up, and therefore the spread is losing value. So you may have to wait. Okay, you may have to wait for it to go back down a little bit. But also notice how the spread is quite wide, from 15 to 5. So, you know, I would actually be quite demanding because, you know, 5 is all the way next to the ask price. So I would just go around 10. I would just go ahead and place an order bidding 10. And if I don't get filled, then I don't get filled. But if I do get filled, you would have a very powerful trade, okay? Because, you know, this trade would imply the use of multiple contracts, given the fact that it's not a very high point value, given the fact that the stock is not too high in value either, and we are using options quite far from the current price. So what I would do is something like that, make it 10. You would decide the amount of units that you want to use, okay, depending on the risk, okay, and that's it, place order, okay, and yes, now the order is in the system. I got here my VLO spread waiting to get filled. I am asking for 10 cents of credit, as you can see, and now it's a matter of patience. Okay, so good. So anyway, so we're gonna conclude the session, guys. We're gonna conclude the session. Before we do, remember your standard deviation has different values as well, Bojan. So that may mean that we are using different versions of TradeStation then. Okay, that has to be the case. Or there is one more thing maybe. Maybe you are using the Black-Scholes model instead of using the difficult to pronounce name here. Jerksund and Stensland. Okay, so that may be another difference. Okay, I'm just I could not think of anything else. Anyway, Bojan was asking as well to review the STZ trade. As you can see, this trade for a while was working in our favor. Right now, this trade is not. With per contract, this trade is providing $197 of pain. The cost of the trade on my side, which is probably much better on yours, because I'm using market prices on my side, isn't it? So was $700, which means that the most you can lose is 700. Okay, so remember with stocks, we don't use stops, isn't it? So let me bring STZ on the screen. So we entered some time ago, and to be honest, I don't remember exactly where it was. It was somewhere in the middle of this move, and it went up for a while, and then very aggressive push down, on July 29, and this is obviously hurting. Okay, actually, it's hurting enough for that stock to have changed climate. Okay, so that stock changed climate. Okay, so now it's a matter of management of your portfolio. Okay, in a very standard, a very standard instruction for me to give you would be just do nothing. The most you can lose is 700. You were happy with that when you entered the trade. You should have other trades running in your portfolio. Some are long, some are short. So yes, this trade is producing some pain, but the other ones you have that which are short should be producing pleasure. Is that making sense? So you should be hedged and you should be okay. So the normal way to deal with this would be do nothing. Okay, and there was a reason why you entered this trade. What was the most you can lose. Just leave it on, because if the market goes back up, it's gonna start making money for you, and it's gonna work as a hedge of your other trades that may be short. So again, repeating myself, I would say the classical action would be do nothing and wait until the stock comes back in case it does, because you have plenty of time until the expiration date. And if it doesn't, the most you will lose is 700. So that's it, right? Another possibility, if you are more active with your management of your portfolio, is that when you have a change of climate, like you did, okay, 3 days ago, then that would be the time for you to exit the trade for the minimum pain as possible and replan on new trades. Now, having said that, that only can be done if you were to find other trades in your portfolio that allow you to balance your delta. Okay, so I'm going to try to explain this very quickly because it's time to conclude the session, right? Well, actually, I passed the time by 11 minutes, so let me try to do this quickly. But basically, let's say you had 3 positions on, where one position was making 200 deltas, the other position was making 150 delta, and the other position is making negative 200 delta. Let's say that's the case. That was your portfolio. So if that's the case, you are net. Okay, you were net plus 150. Okay, so let's say the position that you're about to close is this one. Okay, you have a change of climate, right? And the position that you're about to close is that one. Well, if you close that position, okay, if you get rid of this position and you don't have another long opportunity for you to enter in your portfolio, so what happens? Well, now your portfolio would go from 150 to minus 50, correct? Because now you would have positive 150, negative 200, so you would be net minus 50, which is fine, but it's fine only if the broad markets have also changed climate. So if the S&P has changed climate too, then yes, of course, you want negative deltas for the portfolio, as we have covered in the portfolio building lesson that we did in the sharpening sessions, correct? So again, closing or not would depend not only on the climate, but also in the proper management of your portfolio, because you are not treating one trade by itself. You are treating it in the context of a portfolio where you are hedging your bets with other trades which are positive gamma as well, okay? So keep that in mind. This is now falls into what is your style of trading. How active are you managing your portfolio? Are you very active longer term trader, or are you a very passive longer term trader, right? And how much you want to act on the portfolio has a lot to do with your style of trading, okay? But this would be the answer to your question, Bojan. Dear Jesse Livermore, it was never my thinking that made the big money for me. It was always my sitting. Got that? My sitting tight. Yes, it's so true, and we have seen many cases where stocks that went against us for a while then started moving in the right direction. Remember, stocks are fragile. They depend on external forces. It's not like when you trade crude oil. Crude oil is a market that got personality on its own. It's one thing, right? Stocks, hundreds, thousands of stocks altogether make up for the market. And therefore, each stock individually is very fragile compared to the market. And therefore, when you have a bet, I'm not saying close your eyes and hope for the best, because that's not what we do, because you have multiple trades running that hedge each other, isn't it? but at the same time, you need to give your trades time to react, okay? I'm just gonna extend 5 more minutes the session, if that's okay, guys. I just want to add a little extra here. So we will soon, guys, instead of using the DMI, we will soon begin utilizing AutoClimate, okay? AutoClimate. AutoClimate is gonna give you statistical data that will also help you monitor and manage those trades much more efficiently, okay? By the way, I will have proper sessions to explain AutoClimate properly, but if you guys want to use it already, we have produced a user guide and everything, so take a look at this. If you use the TradeStation website, so tradestation.tradingappstore.com, and when you get here, you type climate, okay? You get AutoClimate, is right here, okay? And this is, by the way, it's a free app, okay? So you can click install, it will download automatically inside your TradeStation, okay? And by the way, if you click on it, okay, you can download a PDF file, which is a user guide that will explain to you how it works. I will do a proper session to explain it, and when we start incorporating it, I will be very detailed on how to do this, okay? So you have here, it's a 15-page user guide that will explain to you how to use it, how to read it, and so on. But basically, take a look at this. So one of the things that AutoClimate will tell you is, so number one, is going to tell you the distance from the current price to the ideal price for you to enter. So how many ATRs away you are from entry. So you can set alerts based on that, so you know if you are far or close to your entries. That's convenient, okay? But what's powerful and has to do with your question, Bojan, is the following values. So number two is going to tell you the statistical duration of up markets measured in amount of candles. Number three will tell you the statistical duration of down markets measured in amount of candles. And number four will tell you, in the current condition, how many candles are you consuming. So, for example, let's say the up markets tend to last 5 candles, right? And the market in which you have been trading took 7 candles before it turned and went against you and stuff like that, like it's happening with STZ. Well, what is this telling you? It's telling you that, if statistically speaking, those markets tend to last 5 candles moving up in that larger time frame, in the common time frame, which is larger, right? But the current market you were trading took 7. It probably means that it was a little bit of an irrational move. So if that market starts moving in the opposite direction, it's probably it's going to be a very severe correction, and it may take a long time before it comes back, okay? So knowing statistical data about the climate, instead of simply looking at the average and DMI, looking at statistical data that tells you more about those market cycles will also be useful for you to know if at any moment in time it's actually intelligent to give up on a trade, okay? So we'll talk about that, okay? It's going to be this collection of dots here. It's going to be very easy to use. I will start using it a little later in time, but if some of you are curious, and I know some of you are, you can just get it and start utilizing it or playing with it, or at least take a look at the manual. So when I cover this properly and we start utilizing it, which is going to enhance our trading even more, right? So you are already familiar with this tool at that moment in time, okay? Anyway, guys, super pleasure to spend 1 hour plus today with you guys. Love it. It's been not too easy today to find opportunities. We got to trade with Netflix. For whatever reason, let me take a look at the VIX. For whatever reason, the volatility, the price of the options in most of the stocks that we looked at today were quite low, and also we had many cases of that's why. Okay, so we got prices of the options going down by 9% today. So the VIX is down 9%. So most of the options were not giving us the premium needed to do those non-directional trades. Okay, and again, that's what the market gave us today. So we'll take it. Okay. So see you next time. This weekend there is no sharpening, by the way. Probably you have seen that in the calendar. So I'm giving you rest until next Tuesday. I'll be missing you guys, but I think we all deserve it. A little bit of a break. It's been intense in recent times, and you know, you guys deserve a little bit of a break. And by the way, if you are eager for more, and you have some videos that you are still catching up on, so you can certainly use this weekend to catch up on some of the recordings. Okay, just an idea. Take care, everyone. Keep up the good work, and if you need us, make sure you send an email. Okay, let us know what you need so we can support you guys. Bye bye. Take care, everyone.